Hi folks, David Raring here again with InformedTrades.com and today's lesson of the day. In our last lesson we continued our free Forex trading course with a look at interest rates and how the capital flows associated with movement of interest rates in a particular country will affect the value of that country's currency. Now that we have a basic understanding of how interest rates move the Forex market, let's help drive this point home with a look at a specific trading example from today's market environment. So let's get started.
For our example, let's say that I am a savvy investor located in the United States who is seeking a good place to park some savings where I can earn a decent return on my money. For this particular slice of my portfolio, I'm looking for an interest-paying instrument that will pay me a steady stream of cash on my money. As many of you are already aware, a government or corporate bond will do just this, paying me whatever the interest rate is as set by the country's central bank that I'm investing in, plus an additional interest rate depending on the length of the bond that I'm investing in. For example, a 1-year bond is generally going to pay me a lower rate of interest than a 10-year bond, and an additional rate of interest for the extra risk that I take on for different types of bonds. For example, a government bond is normally going to pay me less than a corporate bond because there's less chance that the government bond is going to default. So, knowing this, I decided I would like to invest in a bond that pays me a good rate of interest, and I'm not looking to get too speculative about this investment, so I prefer a government bond over a corporate bond. For our example, we're going to say, for simplicity's sake, that bonds of the countries that we have available to invest in pay an interest rate equal to the interest rate in the country as set by the central bank. Now, with this in mind, the next thing that I will do is list out all the different rates of interest of the major countries around the world. And here I come up with 2% for the United States, 4% for the Eurozone, 0.5% for Japan, 5% for the United Kingdom, 7.25% for Australia, 3% for Canada, 8.25% for New Zealand, and 2.75% for Switzerland. After reviewing my options here, it seems pretty clear that if I'm just going on interest rates, then New Zealand is the place to put my money, as this will earn me an extra 6.25% in interest each year over investing that same money in the United States. Now, I'm not going to drag this lesson out by including all the history of interest rates in New Zealand here, but I will tell you that New Zealand has been in a high interest rate environment relative to the United States for quite some time. With this in mind, if I would have followed this logic in the past, then it would have played out very well for me, not only from an interest rate standpoint on my money, but also, as this chart here shows, from a currency appreciation standpoint. Because I would have been investing in New Zealand bonds, I would have been holding New Zealand dollars and also have been benefiting from the large run-up in the New Zealand dollar that you can see here. Now, obviously, hindsight is 20/20, and I've simplified things here for our understanding, but this is not too far off from how international investors, including large market-moving hedge funds and other players in the market, think. It is also a great example of the forces we have spoken about in our lessons on capital flows and in our last lesson on interest rates at play in today's market. That's our lesson for today. In our next lesson, we are going to continue our discussion on how interest rates move the Forex market with something which is known as the carry trade, which is also one of the more popular trading strategies in the Forex market. So we hope to see you in that lesson. As always, if you have any questions or comments, please leave them in the comment section below. And good luck with your trading.